it's a very special advantage to start looking at high quality 13Fs. Okay, you can just go to sec.gov. You can pull down a 13F. For anybody who doesn't know, the 13F is just a snapshot of the portfolio holdings of a super investor. So if you go to a 13F, it helps you eliminate a whole bunch of errors. I think if you start from the standpoint of who's paying the highest dividend, you might find yourself in a bad situation where you buy a company with an unsustainable dividend or where the shares price is really falling. So I think it's more appropriate to come at it from the lens of what's the greatest business out there, and then are there any of these that have a high dividend? And one way to do that, a shortcut way, rather than just screening, because what would you really be screening for? You go look at some 13Fs and you say, okay, so this company shows up a whole lot of times. It's owned by whoever your favorite investors are, but it can be sitting there in Warren Buffett's portfolio and Charlie Munger's portfolio, and Manish Pabrai owns it as well. So you know what? Okay, it's probably pretty reasonable, and it happens to be paying an extraordinary dividend. And when you find yourself in that situation, you can use these option contracts as a smaller investor to just rip these dividends out of the market. And so I just want to point out, it's really important to start from the lens of what's great business, and then where's a high dividend, not where's a high dividend and right. Can I make this work?
And I guess even though this is your 20% capital is say different than your long-term strategy, extremely high conviction on each bet you make, the margin of safety does come into looking at the guru investors who, that's where the margin of safety does lie. Yeah. Well,
the margin of safety is also in just lowering your strike price and things like that, but but you're mitigating your risk in a certain manner. Look, so I always get in these challenges with the efficient market hypothesis, because if the efficient market hypothesis were true, even though it's a Nobel Prize winning hypothesis, firms like Berkshire Hathaway wouldn't exist, because there would be no way for them to consistently be growing faster than the market. It says that that's impossible. So we know that it's not totally true. But the problem is that doesn't mean that it's not true at all. It's actually mostly true. So most securities are priced accurately most of the time. And you need to be turning over so many stones to find a mispriced security. If you start from the approach of a 13F analysis, you're looking for needles in a haystack anyway. But if you look at 13Fs, I think you're finding a lot more needles than hay in that basket of securities. So I think you reduce your risk of making an error. There's a lot of conviction behind those positions that they're going to appreciate. But we see a lot of mistakes and errors happen. Okay, we see Bill Ackman buy in and sell out of Netflix and lose a bunch of money, and so you can't just blindly, everyone makes errors, and everyone has either and there's probabilistic thinking involved, and so you don't want to do this and implement it blindly. But if you have some great companies in the back of your mind that pay a good dividend, you can go in and implement this and probably do very well.
Wow. Yeah, that was amazing. Thank you so much for breaking that down. Really making sure that I understood the process. I will rewatch this.
Thank you.
Going through this.
I'll add just a really quick additional point. And maybe this works for a retail investor with a big salary. It certainly works for a fund manager like us, because we're bringing in capital almost on a monthly basis, and we need to allocate that capital. Fortunately, we have way more ideas than capital. But you asked a good question earlier, and it's we treat this as one position, and it's about 15 to 20% of our portfolio. But when we would prefer, even though this is so lucrative, it's time consuming. There's taxes involved. And also, Jeremy, this will not always work. So you can't, this is not something that you can just implement through. Watch the VIX as a macro indicator, even though I don't really like macro like that. It's a micro level vol that matters. But if the VIX is high, this is probably going to be working well because you're getting high premiums for your securities. Fear is high, so puts are costly and so are calls. If the VIX is low and the world just seems to be moving along perfectly, you're not going to get sufficient premiums, and this isn't going to work anymore. And it's not, especially not going to be worth it after you pay commissions and taxes. So you need to be able to move in and out of this strategy when it's working and then stop when it's not working. The second thing to point out is, as a fund, we're always raising capital. And so a lot of times you feel, even though we're very patient long-term investors, you feel the pressure to put cash to work. We don't mind holding cash. But there is a pressure to put things to work. Otherwise, it's a drag on the portfolio. This allows us to immediately put cash to work. It comes in and we just put it right into the structured dividend capture program. And then as soon as we have a new allocation, we can allocate, to a 10% long-term holding, and we just pull it right out of this. So this is like a use of our cash while it's waiting for a great long-term compounding opportunity. And so it can help people who have high salaries. Anybody who's bringing capital can implement this over the short term until they find their new best, great long-term investment idea.
Yeah. And it's so interesting to see, studying Warren Buffett and Charlie and looking at a lot of value investors. It's a lot of these guys aren't one-trick ponies as well.
Yeah.
They can maneuver in the certain areas that we're in. And so this just does seem, like adding something to the tool belt for when the time is appropriate.
Warren Buffett recently bought a bunch of Activision. And, I don't know if you caught this, but he said in the annual meeting that he just clarified for everybody. And he said, look, our Activision is basically a workout that we used to do from the 1960s. Microsoft's going to buy it. They offered XYZ price. They have the cash. We think it's probably going to go through, and the shares are selling at a discount. So over a few months, we just make 15% or something. So they just bought billions of dollars in Activision. And that is not a long-term traditional Ben Graham value play. It's like an info arbitrage almost play. It's taking advantage of a corporate event. And so truly these legendary investors, they are pivoting and maneuvering even at large scale through these different strategies. And so although we're a long-term value fund, we are not opposed to just, when there's money laying around, we just go in and grab it. And I think a lot of your viewers are probably sophisticated enough to dabble in this, and the ones that do will find that it's extremely lucrative. It'd be fun to learn what companies people like.
Yeah, and not starting with 15, 20%, just starting at maybe 3 to 5% max.
Right.
And then once you get more comfortable, you start, hey, I can understand this. And I know that's what I'll be doing personally as just trying to take baby steps as this, so that you don't lose, all your money.
And even for the folks that have never dabbled in options, you just upgrade your brokerage account or whatnot, and you get to this sort of situation where you can write contracts. And then you look for a company with a high dividend and you just write one and it expires before the dividend. You're probably going to do okay. You have a lot of things working in your favor. As long as you like the firm and it's a good company, you're going to receive a put premium that's going to give you a margin of safety below the market price. Then you're going to get a dividend. And as you exit with a call, you'll get another premium. It's highly likely that you will make some profit. The first one or two might be a little bit of work, but as you get comfortable, I think most of your viewers can go and try this once and be pretty comfortable that it's going to do okay.
Wow. Well, thank you so much. Yeah, this was amazing. And I do want to be respectful of your time. So I would love for you to tell people where they can find you, learn more about you.
Absolutely. So I run a fund, Peterson Capital Management. Our website is petersonfunds.com, and we literally have 11 years of quarterly letters, annual letters, where I talk about all of this. In fact, some of the diagrams I just showed you are available in our 2021 annual letter, so people can go and look up that information there on our website. We also have a growing YouTube channel. Thanks, Jeremy, for all of your advice on that. And yeah, I'm on Twitter, I'm on social media, but I think YouTube and the website are great ways to reach out. And people can always email me, and my emails, I'm not too hard to find.
Perfect. And
hey, it's great to see you here. If you enjoyed that video, I'm sure you're going to love this next one we put together. We'll see you there.